Economic indicators can give us insight into the state and potential direction of markets and the economy. And while that doesn't mean the stock market and the economy are the same, there are economic events that can impact both. For this reason, some investors may pay close attention to these trends. Economic indicators represent economic data and report on matters like general business activity, employment trends, household and private sector incomes, loans, and much more. They can also be considered leading or lagging. A leading economic indicator can give us some hints about the direction of the economy moving forward, while a lagging economic indicator can show what happened within a certain time frame in the past. Now, you might be thinking, what are some common economic indicators? For starters, there's gross domestic product, or GDP. This is a lagging indicator. When GDP numbers are reported, they tell us how the economy performed in a past period. And when economies are performing well, this tends to be reflected by the performance of the companies in the stock market. Let's look at Japan for an example of when GDP and stocks have historically moved closely together. Here we see that both of Japan's main stock index, the Nikkei, and their GDP haven't yet recovered from the respective peaks in the early 1990s, which resulted in low and underperforming stock market returns relative to other parts of the world during the same time. That's GDP. Another common lagging indicator is the unemployment rate. This is the percentage of the labor force without jobs. Generally speaking, investors may closely watch unemployment trends because of the impact they can have on markets. But here, unemployment actually appears to have an inverse relationship. For example, in this near 50-year chart comparing US employment and the S&P 500, the market appears to perform poorly when unemployment rises and better when it falls. All things equal, a hot job market seems to indicate greater business activity in the economy, including higher incomes for both businesses and households, which may then drive stock market performance. Let's switch gears now to leading indicators. First, we have interest rates. When interest rates are adjusted by central banks, this is actually an indicator of possible market conditions to come. Central banks are public institutions backed by governments to keep the state of markets healthy through economic factors like interest rates and the money supply. Altogether, these actions are known as monetary policy. And central banks are often referred to as the bank for banks, in part due to the loans they provide, but also the impacts the regulations and decisions have on everyday banks. When a central bank cuts interest rates, there are investors who may see this as a bullish signal for stocks because it can stimulate the economy and lead to growth. On the other hand, interest rate cuts may also coincide with lower yields on bonds. Let's look at the relationship between the Fed funds rate, which is set by the central bank, and the yield on the US 10-year Treasury. As the data here suggests, since the 1980s, bond yields have moved in similar directions as the Fed's rate. This knowledge might help investors going forward better understand the direction of bond yields in a country if they look at the interest rate set by central banks in that country. The last leading indicator we'll cover is consumer confidence. Consumer confidence is a monthly survey assessing consumers' attitudes, expectations, and spending plans. It's usually seen as a gauge for consumer spending and economic conditions. Over the long run, history has shown that the stock market tends to follow consumer confidence. From this chart, we can see that dips in consumer confidence between 1990 and 2016 occurred at similar periods as downturns in the S&P 500. Ultimately, economic indicators can be helpful in two ways. They can play a key role in markets as businesses tend to thrive in strong economic environments, and they can help us assess the state of the economy. However, keep in mind that no one economic indicator can predict the market by itself. Think of indicators generally as different factors to include in the overall investment research process. If you'd like to learn more about economics and its role in investing, check out our wide library of topics. And don't forget to check out WebBroker to stay up to date with important economic events and announcements.